Hi, I'm Samir Jain. Our clients often ask us, hey, how should I think about asset allocation during monetary policy shifts? So, all of us intuitively recognize that there is an association between monetary conditions and long term returns to different asset classes. The question is, so what should I do about it? So we find that returns to stocks are significantly higher during expansionary monetary periods, while returns to T-bills are higher during, such as now, restrictive periods. But of course, the real issue is nuance. So in my book, Active Equity Management, we demonstrate that size and price to book effects in the equity markets are economically and statistically significant only in expansive monetary policy periods, the last period. So, US expansion, I think, will likely peak in the next, over the next year, if not in the next 1 or 2 quarters, as the effects of tax cuts and fiscal spending wane during the course of 2019. And the expansion in Europe is moderating as a toughening global economic environment challenges their external sector. The outlook for major emerging markets too is under strain because of inflation, a rising US dollar, and domestic economic and political challenges. Monetary policy will continue to tighten, but only moderately unless inflation emerges much faster than what is anticipated. So I've been speaking to some of my colleagues at MIT. Many of them are monetarists who believe that changes in the monetary policy will affect the real economy, and it makes sense too, I guess. So money supply changes affect the valuation of financial and real assets through changes in the expected levels of nominal cash flows and changes in the interest rate that is employed in discounting future cash flows. Finance 101. So a restrictive monetary policy environment, as we are in now, is bad news, and it is generally associated with higher future interest rates and decreases in levels of economic activity, provided probably that's why Trump is upset with the Fed. So if the Fed pursues a restrictive monetary policy, money supply growth is slowed and interest rates tend to rise. And as rates rise, amongst other things, a firm will of course pay more for borrowed funds. And as interest costs rise, the firm's nominal cash flows, depending on the business it is in, may rise or fall. And also, as rates rise, a firm's cost of capital increases. It makes capital budgeting projects less attractive, and exactly why I guess Trump hates it. So, when the Federal Reserve tightens its grip on the money supply, as is happening now, stock prices tend to lose in several ways. First, corporate earnings outlook become less sanguine. Higher interest rates are a disincentive for companies to build their inventories and increase customers' credit lines. And to the extent that price earning ratios determine stock values, and they do, a drop in earnings necessitates a decrease in stock price. And I guess a second more direct impact on stock prices is from a reduced availability of loans to finance security purchases. And of course, an increase in interest rates improves the attractiveness of competing fixed income investments relative to equities. So the logical consequence, I think, is a shift of investment capital from stocks to fixed income to bond type instruments. But the question that one grapples with is, how do we define a policy regime? Because defining a Fed monetary policy regime is certainly not without controversy. So one can treat the discount rate as one of the Federal Reserve's three principal policy tools, and the others being reserve requirements, open market operations. And there are guys who specialize in Fed watching. They keep tabs on monitoring money supply, interest rates, bank reserves, and many other monetary variables. But unfortunately, for the vast majority of market participants, these methods are extremely complex. They require constant monitoring. And I tried it too, and I was stumped, for these variables provide very conflicting signals. The changes in monetary supply may point to a restrictive monetary policy, while changes in bank reserves will signal an expansive environment. So I think, to reduce complexity, a simple binary classification is most useful. If the last change was a decrease, the Fed is seen to be pursuing expansive, and if the last interest rate is an increase, as it was, we can say it's pursuing a restrictive monetary policy. And a new monetary environment starts when the discount rate is changed in the opposite direction. So we should just use these rules of thumb and see what happens to asset class returns during expansive versus restrictive policy periods. And some distinctive patterns are apparent. For long-term bond indices, real estate indices, this expansive period means return is higher than a restrictive period's mean return. So specifically, moving assets out of equity into, for example, commodity futures, real estate, following an increase in the discount rate, and reversing that following a decrease in the discount rate, could be one way. This is not investment advice. One is just trying to see what's there in the data. But of course, return is only one half of the story. One must consider risk. And we find that Sharpe ratios suggest that for traditional classes and also for real estate indices, the return per unit of risk during expansive periods is much higher than the return per unit of risk during restrictive periods. So I guess you're beginning to get a sense of where we are going. My belief is that a restrictive monetary environment is going to decrease expected returns. So it may perhaps make the case to move out from what has served us traditionally very good in the last few years to things like even alternative investments. So there's no real golden rule, but these are just some of the ways we at Active Allocator change our expected returns, our expected risk, our view on correlations, because we allow you to allocate across over 52 asset subclasses. So looking at things within the wider lens of monetary policy is certainly very helpful. Thank you so much for listening in. Bye-bye.